I really shouldn't be trading right now.
Frank, you're trading? We're on the beach. How are you even trading? Is that your laptop?
No, it's my phone.
Oh.
We got the mobile version now, remember that?
Oh, that's right. It's Finder
Yeah,
Mobile.
yeah. That's some good product placement.
How did we even get a plane with our name on it like that?
I used the company card.
Frank, what? How much did that cost? Actually, you know what? We're at the beach. Don't answer that. Frank, how many times has that boat gone by?
What boat?
Frank, it's right in front of us, right out in the water.
I don't see it.
Frank, it's passed us like 4 times by now.
I really shouldn't be trading right now.
Frank, you're trading? We're on the beach. How are you even trading? Is that your laptop?
No, it's my phone.
Oh.
We got the mobile version now, remember that?
Oh, that's right. It's Finder
Yeah,
Mobile.
yeah.
Man, Frank, we finally made it down to the beach this year. What do you think?
I think this is a really great setup.
No, Frank, we're at the beach. We came all the way down here. What are you doing on your phone?
But check this out. It's a really great setup on gold right here.
Our EDGEFINDER summer sale is now live. Get 50% off all of our tools like Commitment of Traders data, economic data, and our top setups algorithm for 50+% off using the link being dropped in the chat right now or the description down below. Don't miss it. This is our biggest sale of the entire year.
All right, guys, welcome back to another live stream. Hope you're doing well. Please let me know if you guys can hear me okay. We are, hopefully you can hear me, see me, all that good stuff okay. We are doing the live stream a little bit differently today just because we had an AC outing at our office. Our office building is just like a wild card. You never know what you're going to get. Some days are great. Other days there's no Wi-Fi. Sometimes the power's out or, you know, the AC's out. It's been a roller coaster. It's a little bit of an older building and management is constantly chasing their tails, but it's okay because we can still get stuff done from home. So we are live streaming from home today. Hopefully everybody's doing well. Armaeus says we can hear you. Awesome. Thank you for that. Hopefully you can see me, hear me, so on and so forth. We're going to be taking a look at markets like we always do today. It's a really big week in the financial markets. We've got jobs data this week. We've got today, I believe we have PMI data. Yeah, we have a PMI data coming out. Let me pull this up. Yes, we have manufacturing PMI data. And the question is, how's that going to come out? Because, you know, PMI data is really important to, you know, the markets, but specifically in like my analysis, I really like to keep an eye on what the PMI data is telling us because the state of the manufacturing components of the US economy are really important to dollar strength or dollar weakness. And, you know, maybe more importantly for me right now would be also to make up some decisions about what I want to do with stocks. Do I want to be long indices right now? Do I want to be on the sidelines? Do I want to be cash heavy? So on and so forth. As we get started here, I just want to say thank you for tuning in. If you could do me a big favor and just hit the thumbs up button on the live stream, that would be awesome. We've got a loaded show here today. We're going to be going all the way up into the PMI data and joined by several guests. So should be a really good day. Let's take a look in terms of market volatility this morning to see what's moving and what's not moving. So really quick, we'll go here. We'll say, okay, so we've got the S&P 500 kind of down. On Friday, we saw a red day for stocks, which is rare these days, but we were red on Friday. The NASDAQ here also kind of trending lower recently, and the Dow Jones actually taking back a little bit of strength here recently. The dollar index was down on Friday and slightly trending up here this morning. Pound USD against and the euro also slightly trending higher here recently off of that dollar weakness, but we'll see if that can continue. Meanwhile, gold was trending up this morning. Big red candle here on the hourly chart just wiped away a lot of those gains. We're trading at 23.27 on spot price for gold. And oil is, I think it's up on the day. Is it up on the day? It might be flat on the day, but big drop, came back. So let's take a look at some of these individual charts. Taking a look at price action, we'll talk fundamentals here today. It is, like I said, a really important day with these PMI data points coming out this morning. Okay, so let's talk the dollar first. So we'll go to the dollar and talk a little bit about where we're at on the 4-hour chart. So 4-hour chart actually does still look pretty strong. We've come back and we've retested a key area here right around this 105.45 level, let's call it. Is that right? Yeah, actually 105.5. Big spot for the dollar. And, you know, as we've come back into this area again, we found support previously. Price was able to make a new high, double topped up here and broke back down. So I think this is a pretty decisive spot for the dollar index. We will probably get some confirmation one way or the other with this manufacturing data this morning. I think it's really important. So I want to show you really quick where we're at with manufacturing PMIs. And if you're asking, is this a Dr. Pepper at 9 a.m.? I would say, no, it's not a Dr. Pepper at 9 a.m. What are you talking about? You're crazy. Anyways, PMI data, here's manufacturing numbers. Remember here, what you need to know about PMIs, okay? PMIs above 50. Also, can you guys let me know? I've got my window open for my cats who are hanging around the desk, by the way. You guys might see one of them pop in at some point. If you guys can hear like their windows open, if you hear like birds chirping or something and it's annoying, please let me know in the chat and I will close that window. But the cats love when the window's open. It's like their television, I swear. Like something about an open window for cats just endlessly entertains them. And it's amazing because it makes my job easier. I mean, cats are just easy in general. But anyways, here's what you need to remember for PMI data here today. If a number comes out higher than 50, it shows growth in the economy. And if you see a number that comes in lower than 50, it shows decline for the economy. Oh, I've got a cat here. Oh, she's running past my chair. So yeah, what we've got here is we've seen numbers coming in lower than 50, right? So we've seen sub 50 PMI numbers. The cats are fighting. I apologize for the interruptions here. So we've seen numbers coming in below 50 recently. The question is today, or what are we going to see? Well, recently numbers have been coming in lower than 50. We're also forecasted to see 49.2 today. So expectations are for a continued sort of decline in the manufacturing PMI numbers. And what does that mean for markets? Well, what does it mean for the dollar first? Well, if you get something that's disappointing on the manufacturing PMI front, it would likely be bearish for the dollar. Because remember, slowing in the manufacturing sector or slowing in the services sector, as shown by PMIs, is considered a negative thing for the economy. And when looking specifically at the economic growth forecasts, that would be bearish for the dollar, right? Now, it would also indicate that, perhaps yields could come down. Perhaps the expectations for rate cuts could come sooner. And I'm watching yields really closely because I have positions basically short the yield, but the longer duration yields through my TLT exposure, which has really dropped on me. So I am actually back in the red on this trade. And I think it is what it is. I mean, to be honest, this has been a position trade for me for some time. I've collected dividends waiting, and this one has come against me. But I do still think there's a good shot that we see rate cuts this year, maybe two, probably one. If we get two rate cuts, TLT will probably have a really nice rally. But if it doesn't, this is one that I'm willing to hold on to. I've been holding on to it for many weeks. I have not made a lot of money on this one, but it's been in the account, and I still think it has plenty of potential. Okay. 49 is still very high for PMI. It kind of depends who you're asking. If you're asking like, are we going to get a rate cut? You know, a lot of rate cut people would love to see like 48s, right? 47s. But remember that just any number below 50 is showing some level of contraction. I think that, you know, recession fears would be if you get down to like the low 40s, that would be, you know, probably spark some much bigger recession fears. Anyways, back to the dollar for a second. So take a look at the dollar on a daily chart perspective. You know, in terms of just a price action standpoint, the dollar looks strong as long as you continue to hold this level of support. If that breaks, you know, if you get a closure underneath that, it is possible to go down to retest the lows of this 105 area. If that breaks, you know, you could continue to see downside. This week is really big though, because with the data that we're getting today, today is important. The manufacturing PMI numbers are really important. Tomorrow, you get JOLTS and you get Jerome Powell speaking. Tomorrow will be a really big day. And, you know, on Wednesday, we have services PMI and the meeting minutes. I mean, it is just a crazy week. Thursday, this is the 4th of July, which U.S. traders will be off the desk for, you know, celebrating Independence Day here in the U.S. And then on the 5th, July 5th, we get jobs data, right? We get our NFP. So it's a huge week and has potential to really set the precedent, I think, for the dollar going forward. Like the dollar has been in kind of this choppiness. If we're going to see a big break one way or the other, it could certainly happen this week. We could see, you know, if you get a really hot jobs print and a hawkish central bank speak, you know, from Jerome Powell, could certainly cause the dollar to break out of this high. And at the same time, again, I don't know what's going to happen with Jerome Powell speaking, and I don't know what the jobs data is going to be. But if it comes in light or dovish, you know, we could break back and continue to stay in the sideways range for the dollar. July 3rd is also a holiday. No, it is not. July 3rd is standard, but it probably will be a quiet day on, well, definitely a quiet day on Thursday for 4th of July, at least in like U.S. stocks and stuff like that. The rest of the world will still be trading. And then Friday will likely be, you know, plenty of activity due to NFP, but outside of that, still, you know, a lot of U.S. people will be either working from home or taking the day off. Okay, so let's talk gold here for a second. I am still long gold. A little bit of a push up here this morning. Rejection wick at this level has me a little bit curious to see what happens here. But I, again, kind of have stayed strong on my opinion on gold. I think that we still see rate cuts this year. I think that a lot of people think that we're just going to get maybe one rate cut this year. I think we might have two. But I also think that there's just a lot of, you know, potential energy with all of the geopolitics that are going on globally, as well as the US, UK, and European elections, all that are happening right now. So you have a lot of potential catalysts that could kind of form from that situation, or all of those situations, right? You also have Taiwan and China, Ukraine and Russia, what's going on in the Middle East. You have so many different kind of potential volatility events. And obviously we don't want to like bet on those things happening. But in terms of like a hedge, this is not the only position in my portfolio, my account. But in terms of a hedge, I think gold could offer a little bit of that risk off concerns due to like geopolitics. I like that idea. In terms of a technical standpoint, we've got this level here on the daily chart that has been incredibly strong, this 2300 level. We've also got a bit of a downward channel here, or a downward trend line, and we are retesting that currently. So which one wins? Well, nobody knows for certain, and there's no 100% technical analysis, you know, that would really prove one way or the other. However, the upward trend that we've seen started this year, I think has the potential to continue, especially if we do see some acceleration on the idea of rate cuts with that. So what I'm saying is basically, you've got this downward trend. I'm looking for the longer term, like the daily chart trend, to kick back into gear and perhaps bring us back to the previous highs. Is that a certainty? No, there's no such thing in markets. I wish there was. It'd make it a lot easier. But probabilities wise, I think there's a better chance that we see a push higher on gold than a push lower. That being said, it's a probability. It's not a certainty. So if price breaks this level of support, I'll take a loss on this one and move on. I've had a really good year so far on gold. So if I take a loss on this, it is what it is. We'd be giving back a little bit of profit. Silver position. I'm also long silver. So we'll see where this one goes. But we seems to have also be trying to hold support on a similar kind of technical basis around the 29 level for silver. If that breaks, again, I think we would probably see a continued push lower, maybe to move down to like 26.25. What would get us there would probably be, if you're bearish on metals, what you'd probably be looking for would be, a really strong jobs print this week would probably support that idea. If you get really strong jobs, it could push back expectations for rate cuts, kind of lock in maybe just one rate cut or even 0 rate cuts this year. If you get a really strong jobs print and perhaps a strong CPI, hot CPI, right? High inflation CPI. So something to think about. But for me right now, I still like my gold and silver position. I'll hold them either to stop loss or until I can start trailing a stop on them. Cats are fighting again. Sorry, guys. Okay, so let's push on here. I want to show you, again, today we get the PMI data, manufacturing data, which will be coming out in just about 35 minutes, 37 minutes. We'll have that data, which could be impactful to charts like gold, the dollar, etc. Here's a quick updated view of what is currently showing up on the EDGEFINDER. We have the AUD USD, the SPX500, Pound New Zealand, the NASDAQ. You guys might notice we did change the naming convention on the EDGEFINDER, which I'm really excited for. We adjusted things to have what I think is an easier to understand description for each chart. So let me show you this. So we have things like the DAX now is called DAX instead of like German 40. SPX500 is pretty universal. The NASDAQ instead of NAS 100. Silver instead of XAG, right? Gold instead of XAU. The reason for this is because people have different brokerages. They trade futures, they trade FX, they trade CFDs, they trade stock ETFs. NASDAQ is not one symbol. There's not one symbol for NASDAQ. There's, dozens really. So we've changed the naming convention just to be a more descriptive name that is kind of universally understood what this is. If I put QQQ, some people might not know what QQQ is. So they're like, I don't know what the heck I'm looking at. But if I put NASDAQ here as the name, everyone knows what the NASDAQ is, right? It's the NASDAQ index. So something, just wanted to mention that to EDGEFINDER users. We've also kind of standardized our name across everything. Even like the Japanese stock market is now just called Nikkei, right? Copper is on here. We've added so many new charts to the EDGEFINDER over time. On the EDGEFINDER, you now have so many different assets. We've added some crypto. We've got Bitcoin added in here. We've got indices. We've got metals now, even some lesser talked about metals like platinum is in here now. You've got Bitcoin, UK 100. Oh, that one needs to be changed. That one should be the FTSE, right? The UK, well, I don't know. We might need to rethink the name on that. US 10T has been in a slight update. This is actually one that I've been really looking forward to, which is instead of US 10Y, which makes you think it's US 10 yields, it's actually US 10-year treasury bonds, which are currently getting a neutral rating. This is one of my setups that I've had recently. That's that TLT idea. Anyways, just wanted to mention that we've changed the names for this. I think it's, to be honest, a lot more simple to pull up charts, and for beginners, it's a little bit more friendly. Also, again, we've got everything from GDP scorings. Let's take a quick look while we're at it let's go to our sentiment scanner let's have a look at what the commitment of traders data is showing us here for the day. This is, of course, the week-to-week filing from the CFTC, taking a look at what institutional money is doing on a week-to-week basis. So let's dive into this. We still have gold as the number one on a proportion basis, most bullish symbol from institutional money. We also have US oil. We also have silver. We have the NASDAQ. We have the dollar. So these are your top 5 most institutionally bullish charts, okay, or assets. At the same time, on the bearish side, we have CHF, the Swiss franc, the Japanese yen, the Canadian dollar, the Russell bonds. Okay, so these are your 5 weakest ones, okay? Now, the next part of this is after we look at the net positioning, what I like to do is take a look at as of recently, because net positioning can be very long-term oriented. Like if you're, swing trading for weeks and months, maybe this is a fine component. But if you're more of a day trader or a short-term swing trader or a scalper, it might be worth taking a look at the latest week-to-week filings, because this shows you what's been bought, what's been sold as of recently. My cat might be jumping up. Coming up. Here's Luna. She is super sweet and sometimes wants to be on my lap, sometimes doesn't. But sometimes she just wants to stand right in front of my computer if I spend too much time looking at it. Anyways, the latest week-to-week filing will show us the latest buys and sells, which I think is really interesting. So you'll notice here, they actually bought a lot of NASDAQ. So we can see the number of long contracts. They significantly added longs, and they actually, more importantly, really decreased their short contract exposure. They also bought platinum, the Canadian dollar, silver, South African rand. They bought bonds, so that was interesting, and SPX. So we've got a pretty interesting report here. Gold, they also bought some gold here on a net basis, because you might say, well, they closed longs, but they closed shorts more aggressively. And that's worth mentioning. The net basis was kind of bullish, right? So something to look at there when you're looking at the COT data is to make sure you're looking at the latest filing, the latest kind of week-to-week report. Okay, so the Nikkei, the Dow Jones, the Euro, the dollar, these are things that they sold on a week-to-week basis. When I say they, remember, I'm talking about hedge funds, banks, institutional money. We can track that through the commitment of traders data that we kind of aggregate and showcase in the software tool that we offer. Speaking of the software tool that we offer, we just launched. You can see that the stream theme changed here. We are now kind of in our full summer theme swing. And with that, we are launching our summer sale. This is a very short-term sale. I just want to let you guys know that if you've been thinking about getting a copy of the EDGEFINDER, listen up for a second, okay? So last week, we did half off the VIP membership. And a lot of people asked us about the EDGEFINDER. They said, can we do half off the EDGEFINDER? And so I've been thinking about that. I've been thinking about doing a sale for the summer event. And so what I decided is we're going to match the offer that we did for memberships last week for our software tool, the EDGEFINDER. If you have been thinking about getting a copy of the EDGEFINDER, this is currently the biggest discount that we're going to do all year long. We don't go any higher than this discount. So if you've thought about getting a copy of the EDGEFINDER in the past, now is your chance. Today is the day. This is a very short-term sale. We're just doing it for this week. And if you'd like to get 50% off the EDGEFINDER, you can currently do that. Here's how you can do it. We're going to be dropping a link here in the chat. If you click this link, you'll be connected to a person on our staff who will get you half off the membership. Let me show you what happens. So when you click this link, it's right here. I just got it dropped in the chat for you. Click chat now. And we just launched this EDGEFINDER 55% off summer sale. We'll give you all the pricing details. If you have any questions, please feel free. Just take a second right now. But again, if you've thought about it, if you're like, yeah, I think I want to pick up a copy, do not wait this week, because this is, I'm telling you, this is the best discount you're going to get. So if you're waiting for a better deal, I'm telling you, it's not coming. This is the best deal. So if you've thought about getting it in the past, we will not go lower than this. We've never gone lower than this. We're not going lower than this. It is 55% off if you message us while we are live streaming right now. So take advantage again. And if you have any questions, please feel free. You can chat with a real person when you start this chat. Someone from our support team will be standing by to hook you up with a copy while that is available. So again, don't miss that. Half off the EDGEFINDER. You get access to all the commitment of traders data, our seasonality tools, economic data scans. You get access to the top setups page. And, you know, guys, I use this every day, genuinely, on my videos. If you've seen me go through my brokerage statements and things like this, I mean, this is the tool that I use to approach fundamentals. We've built this thing every single day for 2.5 years. It is what has kept us in business. We have so many people who love this tool and use it all over the world. And so many people have used it to help them get funded. So many people have reached profitability with the assistance of more data. Many people who want to get into fundamentals find it too daunting. They know it's important. They know they want to use fundamentals in their analysis. They want to use economic data, but they don't know how to approach it. This tool, let us help you with this tool. It is genuinely a really powerful next level tool for people who are trying to get into fundamentals. So again, send us a message if you have any questions. We just dropped that link in the chat, and there you go. Okay, so back to charts here for a second. Yields are up this morning, which may be propping up the dollar a little bit. Yeah, the dollar jumped here a little bit, but yields specifically seem to be up a lot this morning. Gold, I talked about this earlier. I'm curious to see where we go with this data here this morning, the PMI data. See if we can break through that. Can you develop a light version of the EDGEFINDER where there's only COT reports and daily setups, none of the rest features? Cedric, we actually do already have one. We have an EDGEFINDER Pro and an EDGEFINDER Basic. If you'd like access to the EDGEFINDER Basic, it is a lower cost, and it does have a limited version of the EDGEFINDER. If you'd like some information about that, you can message us here on our website with the link that we just dropped a second ago. Feel free to chat with someone on our team about that as an option. And again, I'm telling you, I know it is a sales pitch, but genuinely, it's the best price we do all year. We will not go lower than that. So if you've thought about getting it, now is your chance. Okay, so let me reiterate for those of you who are just tuning in. Today we have PMI data coming in. Let me go back to today. Today is Monday. We have ISM manufacturing PMI coming in at 10 a.m. That's about 30 minutes from now. And that PMI data is going to show us what purchasing managers in the manufacturing components of the US economy see coming down the pipeline. Their sentiment can be really useful and also forward-looking. Because if you have, I like to always kind of break this down and think about it. If you asked a bunch of purchasing managers, people who make decisions at big companies, hey, are you planning on hiring more? Are you planning on purchasing more, supplies, things like that? If they said yes, like across the board, if there was like a really strong yes, we're going to be buying way more, hiring way more, that would be a forward-looking indicator of the US economy, right? And vice versa. If they said, no, things are not looking good, then certainly that could be a pessimistic or negative forward-looking indicator. So this is why I really like the PMI data. I really like to keep an eye on them. And that's why we've got those charts. When I pulled them up earlier, services PMI and manufacturing PMI. Services came in really strong on June 5th. We'll get the latest round of services PMI later this week. I believe we get that on Wednesday or Friday. I think it's Wednesday. Manufacturing PMI today has been in the decline territory, right? Under 50 is decline. We've got some decline recently on the PMI data. We're going to see today what the new data point shows us. Are you long or short, Nick? I'll go through my positions here. Please understand when I share my positions, I'm not here to tell you what to do with your account. This is not financial advice ever. I'm sharing my opinions on the markets. I trade the markets every day. And let's go through what I'm kind of currently situated in. I'm sort of long the NASDAQ. I have a long position on XLK. So XLK is a position for me that I've been in since April. I know this looks too good to be true, but I literally bought XLK like over here. I've been in a position since then. I've got a covered call that I've sold here, which is negative. I've capped my upside to 220. 222 is about my upside. So I would like to actually see this thing come down a little bit, in which case I'd actually look to close out my covered call for a profitable trade if I can. I don't know if I'm going to be able to, but I might be able to. Otherwise, I'll get called away from my shares of XLK. So I am pretty much long the NASDAQ, is a close enough thing to saying XLK longs. It is the technology sector. The NASDAQ is heavily comprised of tech stocks. So yeah. Nick, I'm pumping whatever you're on. Trust me if you do that. Sometimes you'll think I'm a genius and other times you'll think I'm stupid. So please do not copy what I'm doing just because I'm doing it, because there are times where I have like terrible losing streaks. And if you copied me all of 2022, you would be really disappointed because I had a terrible year. So there are times where I'm dead on it and there are times when I'm wrong. And you just kind of like, when it comes with any trading strategy, every strategy does this, right? As long as it overall goes up, that's all that matters. But again, that's the thing about copying is people copy and they like put too much, hope into someone's abilities as if they never get it wrong. And that's just certainly not the case for me. So dollar index, the dollar index really could move here this morning. Someone said euro dollar in the chat. Sure. Were you using the EDGEFINDER back in the 2022 period? Yes, Cedric, but back then it was really only for currencies. And I actually had a great year in currencies in 2022. Well, it wasn't only for currencies, but it was predominantly built for currencies first in early 2022. And late 2022, it started really getting into other areas like gold and indices, etc. And 2023 was an incredible year for me. 2024 has been pretty good using the EDGEFINDER. Now, the principles that I've used in the EDGEFINDER, I've used for years before I ever built a software tool for them. The software is just an automation, just a visual tool that I've always wanted to build. Frank, the other guy who's helped me to build this. He's a long-term friend of mine and works at my company. We built this tool kind of together over the years now. And the whole purpose of it has been to help us to automate so many components to the things that we wanted to analyze and study in the markets. Like I just showed you guys the commitment of traders data, right? You can go through that commitment of traders data painstakingly and, go through each and every part of it and do stuff by hand. But why do that? Why score it by hand when you could have a system built that scores the COT data every week and generates bullish and bearish signals for you? That's the purpose of the EDGEFINDER. It goes through, but then what's so fun about it is it doesn't stop there. It doesn't just look at the commitment of traders data and say that's the entire analysis, because that would be foolish. The COT data is not always right. There's not institutional money sometimes on the wrong side of positions as an aggregate. Remember that the commitment of traders data is an aggregate kind of total of what institutional money is doing. So what's so fun about the EDGEFINDER is it then looks at the retail crowd and sees what they're doing and generates bullish and bearish signals. And then what it does is it looks at seasonality for all of these different charts. You know what seasonality is saying about the NASDAQ right now? It's saying that July is a bullish month. You know how I know that? Because the score has been automated to go check that out for us. Let's go check our theory. If we go over to the month of the year trends, this is how the EDGEFINDER is scoring seasonality. It's saying for the NASDAQ, let's pull up NASDAQ if we can here. Where's NASDAQ? NASDAQ, hello. Am I just missing it? Here it is. Okay, so looking at the NASDAQ, check this out. July is in fact, the #1 most positive seasonality-wise month of the year. So the EDGEFINDER has calculated that already before we had our morning coffee. The EDGEFINDER said, oh, NASDAQ, give it some plus points because look, seasonality is expected to be very strong in July. Is that a guarantee? No, because there's no guarantees in markets. but it's certainly worth noting, right? That's how the Edge Finder works. Then the Edge Finder goes and it says, well, what's the trend looking like? How's the momentum in this chart? What do GDP figures look like? What do manufacturing and services PMIs tell us? What is retail sales? How are the consumer doing? Inflation data, unemployment data. This is why the tool does what it does, right? It's so purposefully built to go look at these data points for us and say, how does this impact the NASDAQ idea? Are we bullish? Are we bearish? Then once I have this bullish reading, how do you use that, Nick? What do you do? What time frame is that for? Is that a scalp trade? Is that a day trade? Is that a swing trade? It's not a time frame specific. We get that question all the time. You know, is this built for day traders? Is this built for swing traders? It's not built for anybody's time frame. This is, generally speaking, a directional bias that the Edge Finder has on a particular chart. So the way I use that is then I go say, and I say, oh, look, the NASDAQ is getting a bullish reading. Let me go look at the NASDAQ. And let me say to myself, okay, so if I'm getting a generally bullish directional bias from the Edge Finder, if I'm looking at the daily chart, okay, great. If I'm looking at the 1 hour chart, okay, great. It doesn't matter your time frame. It's great for swing traders, day traders, etc. What it's mostly meant for is you use that directional bias based on the data and etc. And then you look for your own technical entries, things like that. So for me personally, on the NASDAQ, I'd like to enter off the daily chart. I'm more of a swing trader. It doesn't mean that the Edge Finder is built for swing traders. It's built for whoever. It's not a time frame specific signal. It's just a general directional bias. So for me, I'm looking for a pullback, probably to this level. I might take a stab at a small long position on the NASDAQ. Does that make sense? Can you guys do me a big favor if that breakdown helps? I know a lot of people have a lot of questions about how that functions for the Edge Finder. If that made sense to you, can you just do me a favor and hit the thumbs up button and also type yes in the chat? Just let me know that that made sense. So for the NASDAQ, do I like the setup on the NASDAQ right now? Not yet. I don't like it yet. It could bounce here. But for me, I like the setup. I think that there's a pretty decent setup. If we can get a pullback down to like this 19,500, I'm actually really interested. In fact, what I'll do most likely is I already have NASDAQ exposure, but I may choose to sell or buy back my covered call. I sold a call on the NASDAQ, not the NASDAQ, XLK, which is technology, pretty close to the NASDAQ. I'd like to buy back my call option because things look bullish on the Edge Finder now for the NASDAQ. Again, NASDAQ's getting a bullish reading. That tells me, okay, I want to look for bullish setups. I already have a setup on it. I'm already long the NASDAQ by proxy through XLK. So I'd like to buy back my covered call. Okay, cool. That's awesome. Thank you guys all for the yeses for that. That really helps. You guys, I appreciate when people are kind of like letting me know that something made sense, that it worked out, because then I can move on and know that I got through a concept well. I've been doing this for so long, I sometimes can get disconnected from what I'm saying and making sure that it makes sense to the average listener. It's kind of like if I were to go listen to a doctor speak to his nurse or her nurse, I would be so lost. And even if they tried to dumb it down for me, I'd be so confused by their language that I would say, can you repeat that? So news, Saphir's putting all caps news. You scared me for a second, but we still have news coming, but it's not here yet. We've got 15 minutes to go. We've got the PMI data. Okay, so let me also really quick, just to follow up, if that breakdown on the Edge Finder made you interested, I need to give you guys another quick sales pitch. If you just joined the stream, we are currently doing our biggest sale of the year on the Edge Finder. It's currently 50% off. Let me reiterate, if you've thought about getting a copy of the tool, if you've been sitting on the sidelines, if you're like, I'll jump in on the Edge Finder if they do a good deal, this is your good deal. Today is the day. We are doing the biggest discount of the year. This is a short-term sale. We won't be holding this very long. The Edge Finder is 50% off. Okay. PMI is in 1 minute. Am I wrong? Okay, sorry about that, guys. Yeah, we might have FX Street Let me pull this up. Wow, good call on that. Oh, wait, no, hold on. Did we get it? Did PMIs come out? Let's see. Where's my Eastern time? Eastern Standard. 9:45. Oh, no. We have S&P Global Manufacturing, but ISM is the one we're looking for. That comes out still in 15 minutes. Still, though, thank you for the heads up. It's better that we don't miss it, right? 15 minutes. Yeah. Cool. I had to double check. Thank you for that. Yes. So like I was saying, again, EDGEFINDER is currently, it is our biggest discount that we're doing all year long. We're doing half off the entire thing. If you'd like to get a copy, we've got a couple people standing by, 50% off the tool. So I was mentioning this. If you're somebody who's been like, yeah, I'll pick it up at some point, there is no better some point than this one. This is the lowest that will go. So if you've thought about getting a copy, we're going to drop a link here in the chat right now. What I would encourage you to do is if you have a question, if we could drop that one more time, Chandler or James, click this message, send a direct message to our team, get in contact with someone, even if you don't purchase it today or you're just kind of on the sidelines, please have a conversation with our team about what you're looking for in a tool like this. We'd be happy to see if it's right for you. If it's not, no worries. We don't want to sell it to you if it's not something you genuinely would. You know, we want people who are actually advocates for it. We're trying to grow a community around this thing. And so if you enjoy the idea of using more data in your trading, if you want to incorporate fundamentals, if you want to incorporate, you know, the commitment of traders data into your analysis, you can now do so with the EDGEFINDER at the biggest discount of the entire year for our summer sale. And I think we have someone joining the show soon. So you'll be able to see some of our fun marketing that's coming out. And let's see, we have Ivan at 9:45. I think he's fashionably late today, but that's okay. Ivan is a fashionable guy. You got to give it to him. Okay, so we've got NASDAQ kind of moving lower still. Again, I'd actually really like to see the NASDAQ come down a little bit. I could go ahead and close out of my covered call that I've got. So let's see, you know, I'm really curious to see, look at how volatile gold is this morning. Gold is still my biggest position, even though I do have XLK, which is a large position for me. Gold is still my biggest position overall in the account right now. I don't trade CFDs. So I don't use like lot size, which I know is what most FX traders and CFD traders are used to. Like if you're trading NAS 100 or XAU USD, you're using lot sizes. I trade using ETFs in a margin brokerage account. And so all that means is that, you know, when I buy gold, I'm buying shares of GLD, right? So shares of GLD are $215 a share. So I'm buying some quantity of shares. It's a little bit different. It takes a little getting used to if you're not used to it. But I actually started in stocks first of all the things that I've traded in my life. I started out in stocks and kind of went back to trading ETFs just because of the kind of the transition that's happened with FX brokerages and US clients. I can still trade FX on OANDA, but I can't trade CFDs. So if I want to trade gold, I trade GLD. Other US traders could also trade gold contracts on the futures market, so on and so forth. But I get that question often, Nick, how are you trading gold? I still, you know, do my analysis on gold spot price, but my actual execution is on the ETF GLD. Oh, Ivan's got no power. Okay, thank you. No problem, Ivan. We'll see you on the next one. I will miss you, I got to say. And I also got to say, if you have no power, I guess you're just on your phone, right? How are you? If there's no power, is there no internet? Are you just, maybe you're just in the cloud, Ivan, somewhere. Maybe you're just floating around in the sky somewhere. Is there a reason you prefer that method? Yes, Denise, that's a great question. I get that question too. Why not just trade futures, Nick? And the reason for it is because I trade options as well. So it's really convenient for me to trade ETFs because I'm more of a swing trader first. And so first of all, like I'm a swing trader, so I don't need to trade like minute to minute charts or anything like that. ETFs are not great for that, to be completely honest, because you don't get the extended hours as liquid or anything like that. But what I love about being able to trade ETFs is I can then trade contracts or options contracts against my positions if I want to. So I mentioned like I also love to trade sectors. So I'm long the technology sector, and this sector, which by the way, I need to look at. I'm going to pull up my account here. So I love to be able to trade sectors, individual sectors. I need to check. We're going to go through and see positions wise where we're at. Market is open. So I'm long XLE. How's that doing today? XLE is doing all right. Okay, so I'm long XLE, which is the energy ETF. I bought this. That's going pretty well today. What's not going well for me today is TLT. TLT is a bummer today. We're down $1,000 on the day on TLT. What's up a lot today is this XLK call that I've sold. That's awesome. I might be able to get out of this position here. I've been wanting to do that. I do want to stay long technology. It's the only sector, well, that and energy right now are sectors that I really like. I also like utilities, but like XLU, but I don't like the chart. I think maybe on a day, on a weekly basis, it might be nice, but I'd like to see like a break of this downward structure. So XLU, XLE, XLK, what are these things? Because I know a lot of you guys trade FX, you trade, CFDs, you trade futures. These are just individual sectors in the form of an exchange traded fund. So on the stock market, the US stock market, I can trade, if I want to go buy a basket of stocks in the consumer discretionary sector, which would give you stocks like Amazon, Nike, which got destroyed recently, Tesla. These are discretionary purchases kind of stocks. That's a sector. And I love being able to trade individual sectors, which is why I'm so partial to ETFs. And that's the long story short why I'm trading that. I'm also long Bitcoin, and Bitcoin is doing pretty well today. I'll go back to my account here. So IBIT is a Bitcoin ETF. That one jumped over the weekend. I don't know if you guys saw, Bitcoin was up a nice amount this weekend. Silver, I'm still flat on this trade. TLT, I'm in the red. Gold is in the green. And XLK, very in the green, but working my way out of, hopefully, if we can get a little squeeze lower on XLK today, I might be able to get out of those calls, which would keep me from getting called away from my position. So XLK, we'll see how that one goes, but I would like to see that squeeze down just a little. If we can get down to like 222, 222, then I'm going to probably look to close my position there on the technology. I'm sorry, close my calls that I've sold. So yeah. Ivan says he missed me too. I was looking forward to it, Ivan. All weekend, I did nothing but prep for our call. Oil's up a little bit today. This is, okay, so keep an eye on this, guys, because oil rising is not what the doctor ordered right now. And part of me wonders if there is some connection between oil up, NASDAQ down. Is the Russell down? The Russell is not really down, but yields are up. So yields being up, again, not great for my TLT position. But we'll see where that one goes. Silver is up just about 1% on the day, which is coming back from the dead on my trade. I was so close to getting stopped out on this one, which I would have been fine with. I mean, obviously nobody wants to get stopped out, but it would have been fine if I got stopped out. But it seems like we've at least found some support here for now. So we will see if that one wants to continue. For gold, what I'd really like to see is a break of this downward kind of lower high pattern. I would get really excited if I could see gold break through these highs. Guys, I think we have a surprise guest here. So maybe we can just bring him in for a second. I think he's on his phone. And we can say hello to No Power Ivan. And hey, Ivan, what's going on?
Hi, there has been power. It went and goes and comes and goes back. So I'm here.
You're here. Well, we'll treasure these moments as long as we can. And Ivan, so this week is really big. We have NFP this week. We have meeting minutes. We have PMI data. What are you looking out for most? And I guess, do you have any thoughts on this week?
Where are we? NFP on Friday. There is some CPI out of Europe on Wednesday, as far as I remember. Those are my two big tickets. And I want to see how dollar yen does it. If it continues above 161, 162, is there some interventions there? That's always fun. But other than that, surprisingly, I am leaning towards a bit of dollar weakness, maybe the next 2 weeks.
Okay. What kind of got you to feel that way? Do you think commentary from Fed officials could be more dovish, or do you think the data itself, like the jobs data or inflation reads, could come in soft?
Or it's pure seasonality and what I tactically do. We had a bullish week last week. So they kind of seem to like give each other ways in the summer. That's kind of the only way. But also to me, Fed is mixed or pausing. So it's up to the market to do whatever they want. There is no major drivers at the moment in the market. There is no risk off. There is no like geopoliticals maybe, and also for a presidential election, it's kind of tied. Both are not leading by a big margin. So it's down to what the market wants to do to drive the market at the moment.
Yeah, that's totally fair. And I think that, the thing that's so pivotal for me in the month of July is you mentioned some seasonality. We are going into the 7th month of the year. We came into this year with 6 rate cuts expected from the market and 3 rate cuts expected from the Federal Reserve. That was, in late December going into January. People were thinking that the first rate cut was coming in March. Meanwhile, we're in July, no rate cuts so far. I would say we have a lot of data in front of us this week, but this week is so important because if you get a perfect storm of data cooling this week and next week with CPIs and with the July meeting could be live. There is a possibility that if you get that data coming in soft, the first rate cut could make its way into July. Now, I'm not saying that has to happen. I kind of think that, probably unless something really drastic happens this month, we see our first rate cut in September. But if you're really dollar bearish, what could certainly get me even more dollar bearish would be if you got some soft data this week. Do you think that's possible? Is it possible we see a cut July 31st?
What is PPI at the moment, and what is PCE at the moment?
2.2 and 2.6. 2.6. Yeah, right. That's a good point.
Yeah. So if you get lower CPI, then everything else, at least with inflation numbers, lays flat. But so currently for the September meeting, I think currently priced in, is it 50-50, like maybe like 47% or something? It's not a lot being for the September meeting. For July meeting, it's 10% chance, I guess, being priced in that they're gonna cut. So if that starts to happen, then you definitely have a case talk to the Fed and say, hey, July is actually gonna go live. And that's not normal, but it would be fun if they did so.
Yeah. And to your point, so I just pulled it up. So we have about a 60% chance, 65% chance that we see our first rate cut by the September meeting completion. As you mentioned, there's about just under 10% chance that there is a rate cut coming in July. But again, what we've just talked about, which could be very swinging of this number, you could see this data completely change in the next week and a half, 2 weeks, with CPI and with NFP. As you mentioned, you have PPI and you have PCE in the right direction and, kind of closing in terms of the Fed's targets. But the really last dominoes to fall would be those jobs data points coming in light and the CPI. But yeah, again, as you've alluded to here, we are currently looking at about a 10 to 90 ratio on whether or not we see our first rate cut at the end of this month. But that certainly, for everyone listening, please understand, these are expectations which can be, swung massively by latest rounds of data points. So we just had also, just as we spoke, we just had our data point drop for the PMIs. Let's see what we've got here. So we had the ISM, let's see which one it was. ISM manufacturing PMI for June came in at 48.5 compared to consensus of 49.1. That is a lower than anticipated number. Same thing with prices paid, PMI, new orders index was slightly hotter. Employment index was slightly lower. So seems like a bit of a, let's see, go down to our 5-minute chart, a little bit of a bearish reaction from the dollar.
Told ya. I don't. That's good. Well, it's not good for businesses, but it's good that it's below 50 and that we are also again showing signs of weakness and that the economy is deteriorating. This is promising for your rate cut in July.
Yep. That's certainly a one step in the right direction. And for those of you guys who are kind of newer to this stuff, one thing to think about here is that if you do get a cut in July, it would be a big surprise to markets. It would cause gold to surge higher. It would cause a lot of kind of more sensitive areas of the stock market to surge higher. The Russell would surge higher. The technology sectors would certainly surge higher. So we'll see. But again, it's a little, we have so much data this week. Manufacturing is a smaller component to the U.S. economy than services. So services on Wednesday will be very important as well. But we'll just have to see. And maybe, Ivan, we'll have you back. Well, actually, I know we'll have you back later on this week to comment more on it. So thank you for jumping on here in an emergency fashion to help us out. So thank you for coming on today.
Thank you for having me.
All right. And also, guys, as Ivan says goodbye, please make sure to go follow Ivan. We're going to drop the link to his YouTube channel. He also does offer one-on-one coaching. You can hit him up for information about that. So if you're looking for like one-on-one coaching, if you're looking for some extra help, Ivan might be your guy. So we'll drop the link to his YouTube channel where you can go find him and send him a message if that's something you're interested in yourself. Okay, so real quick, we are going to roll a quick break, and then we're going to be joined by our next guest. It's Chris Pulver. He's coming in just after this. Stay tuned. We'll be right back.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker Eightcap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to Eightcap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now back to the A1 Trading Show.
All right, and we are back with Chris. Hey Chris, how's it going, man?
What's happening? Happy Monday. Interesting week we have here with holidays, but yet we still packing in some information. Jerome Powell speaks this week. We have ADP non-farm. We also have FOMC minutes, and then we have non-farm payroll right around the old holiday on Thursday.
Yes, it is going to be a hectic week, to say the least. I mean, starting off with a bang, we had PMI data come in softer. I don't know, you might have been listening to a little bit of that conversation, Chris. We were just talking with Ivan about the idea of, is there a possibility that July meeting could swing into becoming a live meeting? I think right now there's like a 10% chance that we see a rate cut in July. It's not very high, but you also have to understand it's a 10% chance before we get the data for July. So we could, between now and then, see ginormous swings and hence volatility in the markets between now and the time of that July meeting to when they actually make a decision whether or not they're going to cut or hold interest rates. I mean, is it possible, Chris? This is my other conspiracy. Frank and I keep talking about this. Is it possible that people are people, human beings are human beings, they want to keep their job, and the presidential debate seems to have gone really well for Trump, and he's made mention that he would do some changes to what the Fed's got going on if he were to take presidency. Is there some conspiracy work here where Fed officials may want to keep their job? Maybe if data comes in soft, they'll be more willing to cut interest rates sooner. Is that possible?
I don't think it's going to matter if Trump wins. I don't think anybody in the Fed's going to feel comfortable. I don't know. I mean, we're talking about
what I'm saying, Chris, is that if there's a possibility to assist the incumbent, candidate, Biden,
but
by
will it be Biden?
Rate cuts.
I mean, are you seeing that right now? It's like, and
I am. Yeah.
I mean, the fact that the Democrats are maybe trying to scramble to find a new candidate, it's like, who knows how that's going to be received? I mean, I'm fine with it. I could care less. I'd rather vote for four years of a shadow. It's like take zero presidents right now. It's like, this is a joke. I hate the fact we're even talking about this, and it's going to be now front and center until November.
Exactly.
to get the conspiracy, I mean, I do think that the Fed cut that is the most probable right now, September, is really what the market expects. The market's done a really nice job of not panicking, expecting 5, 6, 7 cuts and ripping the way that it did from Q4 to Q1, and now the market's backpedaled into maybe thinking 1 cut, maybe 1 or 2 cuts by the end of the year. If the Fed cuts in September, I really think that is just a sigh of relief for the consumer, a sigh of relief for small business, a sigh of relief for the housing market. I mean, to consume some interesting content this week. The consumer in the U.S. is not buying goods, but they're buying travel and
I've seen that
leisure
too.
And so I mean, it's hotels, it's cruise lines,
Carnival. Yeah, I've seen that in the
experiences,
earnings stuff too.
Yeah, so that's been where most of the money is going as far as is buying. Also, most of the consumers, surprisingly, like our real estate market is keeping the U.S. consumer pretty flush, pretty liquid, which isn't a great thing because, I mean, if you're sitting on equity in your home, the only way you have access to that is by borrowing against it. But when a lot of people have seen over the last 5 years, housing prices increase, 50%, sometimes 100% in certain areas in certain cities, that's a lot of cash to tap into that. Hopefully, if you're borrowing on that, you're borrowing at a affordable rate or you're leveraging that in some capacity. But it was interesting. Like a lot of people, it's like 96%, 97% of mortgages in the U.S. are fixed rates and not variable, right? So the idea of, we don't have this crazy thing like in Canada where every 5 years they're reassessing variable rates, and it's so you go to the market. So, I mean, anyway, the Fed cutting, I don't know, man. I mean, I hear the arguments both ways. I also hear that the Fed shouldn't cut. I hear that if the Fed cuts, it's going to flare up inflation again. These markets going to rip. You got, I mean, just you said earlier with Ivan, if small caps rip and gold rips and all these things are going higher, the Fed can't contain that type of asset appreciation, which also puts us into a bit of a bubble. I don't know. So, I mean, it's not going to be easy. And this is the same conversation we've had many times. Very few times in history has the Fed gotten it all right. And if they decide to cut and the market doesn't react the right way, or the market reacts, crazy bullish and bubbly, or the market tanks, that's the Fed breaking something or the Fed doing something stupid when they should just stay out of the way. But with this year's election, the Fed may be a little bit more political in that sense where, sure, if they cut, maybe it's good for the market. But I think the Democrats right now have a lot of problems where they're trying to figure out, who to vet, who to get in there for a potential candidate. And like I said, man, I don't even care. It's like, I go back to a South Park reference. It's, it's a turd sandwich or something else. I mean, you can fill in the blanks, but you've seen the episode I'm talking about. But you don't have good choices, and it just sucks to be thinking like that's the best we can do as a country with a stupid two-party system that gives you nobody. And certainly in this case, it's not any better. So like I said, I don't vote. I don't trade politics, but certainly you trade policy because that has a big influence on what the market does for the next 4 years.
And speaking of policy, I think that, the market definitely so this is TAN, this is the solar ETF that I talk about periodically, obviously helped by a lot of the tax incentives and the the Biden administration making kind of a push for this stuff, or at least the expectation that they will do so or continue to do so. So TAN traded much lower here, right around when the debates happened last week. Yeah. So I think that that's kind of interesting because that is kind of a tell of what the market is feeling, at least for now, about how the debates went. And as you mentioned, we'll see what happens with the Democrats, whether they change out who their candidate is or whatnot. But in terms of financial markets, I think that you're looking at a lot of potential inflation. I would agree. Either ways, they both spend a ton of money in their respective administrations. Neither of them is exempt from that, and either one will again probably continue to do so. So, I think that what that does is it kind of keeps me cautious as to what I want to do with stocks, what I want to do with markets, and I kind of continue to like my idea with gold and silver of just that potential kind of commodities hedge this year, just because of their lower correlation directly to the stock market. I do think that continued spending could keep continuing the stock run for some time. I'm willing to stay long tech if I can keep it, and other areas. The Russell is an interesting one for me. I think it's going to be at some point the trade of the trade of the decade, maybe, is small caps being so blatantly underperforming for some time now, for several years really. And I think that will change at some point, but you're probably going to need to see continued spending. You're going to need to see inflation kind of normalize a little bit and growth kind of reaccelerate for the Russell to finally get up and running. So we'll see. What are your thoughts on the Russell right now?
Yeah, I mean, it's the best index catch-up trade we can have right now. I mean, I look at all of these, the SPY and the Qs, I think, need to have a pullback. This week with kind of an odd week with a holiday right in between. I mean, this is last week's price action, right? I mean, Friday was a crazy day to finish out the month and finish out the quarter. I was long the SPY to a 548 call, had some extra profit. I turned a 64 cent debit into like $2. That was all on Friday's movement. And then we tanked on Thursday or on Friday as well. I think Frank had a long put at 550, which paid pretty well for the day, but I think he's holding it to today. Hopefully it goes a little bit lower for him. But this is what I'm looking at. If we break last week's low, okay, and we take out, not just last week, but the week before, then our CPI gap comes into play, which puts us down into like the 537 area. And then, I'd say we're a little bit more vulnerable to the downside just to have a correction. We're talking, 2%, not in a single day. I mean, that's been the one thing, we're 350 days or something without a 2% day. But we could have a 2% pullback. We had a, 6-7% sell off in April. So let's see if we can get like a 3-4-5% correction. But maybe we don't. I mean, we have 2 weeks of indecision, but the SPY, overstretched with divergence, the Qs overstretched with divergence, the Dow, I like the Dow for this. I mean, they kind of look a little bit toppy, Nick, but I see a potential ascending wedge where we have this push up here, maybe some consolidation on the Dow. It does look a little toppy where if it starts to break and get vulnerable, it doesn't look great, but ascending wedges usually are facing this. They deal with some indecision. Get rid of my squiggles here. And once we have this market pushing up with equal highs, this is the blow off you're talking about. The Dow might be okay. If we see some heavier sector rotation, the Dow probably benefits from that, even though it's price weighted, which is, I think, at some stage is helpful, even though it hasn't reached all-time highs like we had the SPY. But the Russell, I keep going back to the Russell. I just want to see this trade work, man. I mean, if you go IWX, that's Russell growth. If you go or the top 200 rather. What is the what's the small cap growth? It's IWF for growth and IWX for the top 200. Your Russell, I'm long the Russell. I'm long Russell futures. I'm long the IWM, but it's with options. So I'm essentially just collecting income. But this trade to get to the all-time highs is 21%. I think my favorite thing about this is you can measure it. So are we going to have a 20% blow off in the SPY and the Qs? Maybe. But to see this as a catch-up trade, if we have a rip like we had in late 2023, the Russell can outperform everything for that, quick rotation. There's lots of opportunity right here. I just think it needs to be confirmed. So, how much longer does this go? Maybe through the end of the summer. Maybe if you're right, maybe we come into the summer and the Fed cuts in September. Maybe this is what gets the market going, and we just have September, Q4, doesn't matter, blow the top off, let this thing rip. Both parties, like you said, whoever comes into the presidency, whether it's switching up the entire checks and balances with a new administration, they're both going to spend money. I don't think anybody thinks that like Republicans come in and we're going to austerity. There's no freaking way. This is going to be about decreasing the dollar. This is going to be about, influencing the markets and decreasing taxes. And if it's economic focus, it's going to be everything. It's going to be the kitchen sink. It's like people are swinging more to the right, more to the left. And I think the government's doing the same thing with fiscal policy. They're swinging more and just spend and print, just depreciate, just debase. So, I like hedges. Gold is good. Silver is good. Two of my favorite trades right now. And I want to remain long equities. I think the indexes are pretty straightforward. I think the market's going to continue to ignore a lot of things this year. But it just feels like we're rattling off all these things. And it's like, yeah, the market can go higher or the market can tank. But at the same time, we have to be ready for – there's also an in-between, Nick. The market doesn't do anything. There's an in-between. The market just kind of slowly, steadily hums along. And everyone wants these blowout tops. Or everyone wants this crash. But the reality is what happens, the market just kind of steadily does what it does, which is it tries to.
And that's the thing is, I think a lot of people are so used to last couple of years, which have been a very trendy couple years.
4 years, man. We haven't had sideways in 4 years.
Yeah, it's been just trendy one way or the other. And then, if you go back in history, there are periods like 2015, which were just, let's take this as kind of let's stretch this out. You could have said basically from like August of 2014 until, February, March, really all the way until here, you had this range on, the NASDAQ for several months. So, and then, there's also periods, let's see if we can just go back further. The 2000s were one ginormous range, which was an incredible, that was another thing too. Between, I think, 2000 and 2012, value outperformed growth. And that's a long time for value to outperform growth. A lot of people, again, in this bull market phase, they believe that growth just simply outperforms value. And while it may over very long stretches, there's also long stretches where value can really outperform, especially if we enter into a bit more of a growth slowdown. If that does occur, you very well may see the Dow Jones do well. Now, again, that growth slowdown would not be good for the Russell, but we may also just see, like you're saying, a phase where we just kind of go sideways, where we don't see a massive, shift in the economy. Maybe the economy just kind of hangs in there. It's not super impressive. It's not super terrible. Maybe that's the catalyst to a sideways market, Chris. People just speculating both ways. Oh, it's going to slow down, or it's going to heat up again. Maybe it just kind of hums and it doesn't like. Yeah.
Let me throw some numbers out at you. I thought this was really interesting this weekend. Just listen to some good content. The tale of two markets. Just in 2024, some of these gaps and some of these spreads and some of these differences between this index or this instrument versus this instrument. So U.S. large cap, just take the SPY versus U.S. small cap. Okay, you can take the Russell, you can take the IJR. Small cap versus large cap. Large cap's around 15%. Small cap, -2. About a 17% spread in difference in performance. That's a big difference, okay? U.S. growth versus U.S. value, about a 15% difference. Growth obviously outperforming value. The U.S. versus international, about a 10% spread. U.S. is up 15%. International is up about 5%. We haven't seen higher highs in Europe. We haven't seen higher highs in Japan. We haven't seen higher highs really anywhere in the world outside of the US, right? We saw higher highs into March and April, but those major indexes, if you look at the DAX, the FTSE, the Nikkei, they have not made higher highs since March or May. But the US is outperforming by about 10%. You look at this all the time. SMH, semiconductors up 48% for the year. Take one of the crappiest sectors in the US, that'd be regional banks, down 7, almost 8%, 55% spread. So that's your tech versus value, if you will, or just finance. Short versus long duration in bonds. Okay, short duration's up 2.6, long duration down 8%. That's a big spread in difference in bonds. We only have about a 0.3% inversion right now. But somebody asked me this morning, what about the TLT? What about the 20-year? If you look at the 20-year, the yield's not cracking. If we go to the US 20-year, US 20-year. Yeah.
I'm listening, Chris. I just got to shut my window. One sec.
Oh, you're good. So the 20-year bond yield is right here at 4.73. I mean, it'd be nice to think like, if I just, parked money for the next 20 years, didn't have to touch it, collect 4.73% a year, risk-free, it's pretty good, right? But the issue is, we're still in this 350, almost 400-day inversion. We're getting to that 2-year window, which is going to be really interesting. October 2024 is going to be 2 years since we inverted. It's got to matter. It's like the 3-month and the 10-year have typically always been right when it comes to some type of recession indicator. Same thing with the 2-year and the 10-year. We can actually look and see that spread. And then dollar versus yen is another one, like crazy tale of two markets, where I talked about this morning, Nick. This is one thing. I don't know if you and followers are trading the yen, but what's interesting is the Japanese yen and the Bank of Japan don't necessarily intervene when it comes to a certain price. But what they do is they tend to intervene when it comes to rate of change. And so when we had this intervention right here, this October, November of 2022, that was a depreciation on the yen. We started intervening here. It was about a 10 to 11% move, and we ended up stretching around 16% before they really started to put that pressure on with repricing the yen. We're looking at the same type of window. I just said ballpark wise, if we take this recent run from let's say the last intervention, we take the same low. So you go to this spot right here on the yen, right here. If we go up another, let's say 9 to 11%, where the Japanese yen gets weaker, that might be another level of intervention. And I'm ballparking this, but I'm saying 165 to 170. So I am not calling the top at 160. I said to traders, if we hit 160, doesn't mean I want to be short. If there's no confirmation to sell it, don't sell it. This just stays in drift mode. But 165 to 170, again, it is so difficult to trade as a currency trader. You can't just anticipate and get rewarded by the Bank of Japan. Maybe you can, but that's probably not going to come with I picked the perfect stop loss for a Japanese yen intervention. That's probably not going to happen.
Yeah, very, very difficult to do for sure. And you've got dollar yen, as you mentioned. The chart just looks just like it's just going to want to keep trending for now, but we'll see where that goes. And as you mentioned, the rate of change concept is interesting. It would make sense that they would kind of want to jump in when it's pushing aggressively to try and jump in front of something that's happening.
And so, and let's think about the timing, right? Let's say that this just drifts, and it's maybe not crazy running, but look at every day, if the yen goes up 50 points, and then we pull back and we go up another 50 points, we pull back. It's like if we, for the next 2-3 months before the Fed starts to cut in September, if the Fed cuts, but I think they probably will. I still keep going back to something's going to break. In my opinion, the Fed's not going to get away with like this type of extreme policy that we've seen the last couple of years. Something's going to break, and that type of event. Another thing that can make your plays really easy would be, look, if I'm right about this and just kind of ballparking that 165 to 170, it doesn't mean I want to short, right? It just means I'm looking to see if the yen's going to deleverage, if the yen's going to all of a sudden be a repricing event, then it would be pretty simple. Let's see if we just break the inner trend line, go to an outer trend line, come back and retest previous resistance. Because when it comes to these moves, it is actually obedient. Like this swing right here from low to high, it pulled right back to the 50% on a fib swing. So it works, but we have to wait for that to happen. So I'm watching the Japanese yen from that regard. And also, if you want to know, my gosh, the market's going to tank. All you have to do is look at this. Okay. If you look at high yield bonds, this is essentially your widening credit spreads. You know, one thing that's always been a precursor to a volatile market and potentially things breaking loose is when this changes. Okay. Look what happened in February and March of 2020. Right during when we had the expirations from February to March of 2020, look at what JNK did. Dumped.
Yep.
Okay.
Yep.
If right now you see that JNK is going nowhere, this means that credit spreads are pretty tight. This means that the overall spreads in the market are tight. If these widen, this is where things get worse. Okay. So if we start to see this going down, sure, volatility is coming. Market's probably going to sell off. To what degree, we'll find out. Okay. But if this is steady and this is sideways, the market's just going to hum along. And this is where, you know, you read we expect a bull market, we expect a rip, we expect a blowout top. Pausing or drifting or going a little bit sideways, not having it be super exciting, is actually okay. You know, I have a lot of positions that should be profitable, very profitable over the next 30 to 45 days. Take some profit, redeploy, do it again and again and again. And hopefully that's the case if we're going to go sideways. But I you know, it just seems like you got to price in so much of a black swan and so much of your cover your butts. And I mean, and it's okay. You should have something where at least, you know, if we have a 10 to 20% drawdown on the markets, you're not on the hook for all of it. You're trying to be as diversified or non-correlated as possible, so you're not just going tick for tick with what the market's going to do on a large cap basis.
Yep.
So, but anyway, I'm just watching
Makes sense.
JNK, and I think that the Japanese yen was an interesting piece of news this weekend to kind of give me some perspective on. Okay, so it's not a level that they intervene at, right? This isn't the Euro Swiss pegged at 120. The dollar yen is not pegged at 160. It's just ready to change. So if it's 9, 10, 11% that it appreciates, that makes a big difference when the Bank of Japan might step in. But I am not trying to time a Japanese yen intervention. I'm just saying, don't be surprised if we drift up there, that we actually have, and seasonality wise, typically the yen, if it's going to strengthen, it's usually a late in the year move. It's a November to January, end of the year type move. And if that is the case, we could see a nice, couple thousand pip retracement, which would be great for Forex traders. But man, tough to time that BOJ stuff. So trade.
Yeah,
carefully.
no, it certainly is. Chris, I'm going to have to let you go. I'm at home today. Our AC is out at the office, and the landscaping is about to walk by, so it's about to get really loud. So I'm going to leave you to do it. I think Frank's going to join here in just a few minutes.
Okay.
So you'll see from him what he's got in terms of all this volatility, what he's up to. But thanks for coming on, sharing your ideas. Before I step out, guys, if you're enjoying the show, Chris has got his own social media. You can find information on that. We'll drop the link to him there. If you're watching on Twitter, it's at @RealChrisPulver, and I got to run. So enjoy the show, Chris. You got
All right. Thanks, Nick.
See ya.
All right. Let's talk dollar index for a moment. Frank pops on here. We'll chat. I wanted to see what my price is on the SPX this morning. We're at 54.60. So I'll look at a little credit trade there. Let me jump into my Tasty account. And also, I'm not sure if anybody saw this. I caught this over the weekend. Is doing some research. Chewy was the latest meme stock. We just ripped from $17 up to $39. I have been long on Chewy, but I didn't get that trade. I didn't get the 130% rip to the upside. We're fading back a little bit, but because there's a bunch of implied volatility, I was able to roll up my calls and out my calls. I just increased my profit potential by $10 if we're going to actually sustain this run on Chewy. So anyway, I mean, I go from basically a $16, $17 cost basis with a covered call that was August 2nd at $27.50. And maybe it doesn't get called away, but anyway, I rolled it out and up to $37.50 to give myself another $10 of profit and also collect another 70 cents to lower my overall cost basis. So I do own Chewy like $17. But I'll let it ride a little bit. This could be hopefully, I mean, not just a freaking pump and dump where this thing jumps up to $40 and then tanks all the way back down to 20. I also had some good trades on Chewy this year where I flipped it for about $5 or $6 a share for some of my larger accounts. And that was good stuff, right? So anyway, let me take a look here, get rid of the dashboard to go to my portfolio. This was up about 10K probably 30 minutes ago. It's pulled back a little bit. I'm going to look at some trades in gold futures, silver futures today. Probably just looking to collect some income overall. staying, tilted bullish on most of those. Index wise, kind of like where I'm at. We have 5 companies reporting earnings this week, so there's nothing too exciting there. Let me see if I can get in.
Well, that was unexpected. Chris just disappeared. So hopefully he'll be back in a second. There he is. Okay, Chris is coming back right now. Or maybe he's not. I think he's still frozen. So in the meantime, I'm going to sit here and stall for a second. We're all working from home today. Chris has joined back. Chris, are we good? Okay, now we're good. All right, Chris is coming back for real. I kid you not, he just disappeared again. Frank is here, though. Frank is in the office. All right, Chris says 1 second. Frank, hey, Frank, can I pull you in here for a second? All right, I'm pulling you in. Yeah, we're streaming, and Chris has disappeared on us a couple times. I'm not sure. I think he's having issues with his computer. You're in the office.
Yeah, it's hot in here, man.
Yeah, I bet. It's supposed to get up to 90 something today, like it has been the past couple of days. But yeah, we're all kind of working from home today. AC is out in the office. Nick just left to go do some other stuff, and Chris is having some issues with his computer. So we're just kind of stalling for time right now to see if Chris comes back. But Frank, if you want to share your screen and go over anything.
Yeah,
I know the people would like to hear your thoughts on some stuff rather than my mumbling I've been doing for the past 2 or 3 minutes.
right. So you saw, I guess we all had the same news. PMI came in softer than expected. So I don't know. What does this tell us? Is that just another sign of a contracting market, or are we just, are we seeing optimism for the rate cut side? Like what is investor sentiment? And I think this candle and the past couple of candles have told us that no one really has an idea yet. So even if you go down to lower time frames, you see these strange moves intraday. Sorry, I was looking at Chris in the background.
Yeah, Chris is back and he's getting set up. Are you good to join back, Chris? Thumbs up or thumbs down? Thumbs up. All right. I'm gonna back out of here and I'm gonna let Chris join back in. I think that he's got his thing figured out now. So we're gonna bring Chris back in.
Okay.
All right. Frank,
Chris?
man, sorry. So just you're gonna keep the screen. I had this happen on me last week. Every now and then, my browser, so Chrome, for example, will start just like sucking all the juice out of my computer, and so I had like a memory leak on Chrome. And anyway, I was down to like one browser trying to just keep the stream up. So I'll figure that out and troubleshoot on my own. But sorry about that. So I want you to keep the screen. We'll just talk charts and then.
Yeah,
I think it might be time for me to pack in this, trading computer for a decade that's been good to me, but I don't think it's going to cut it anymore. It's been having these issues, and it's weird because it's always Google Chrome. Like I'm running, usually 20 browsers a day, and I try to scale it back, but it's still something's going on. It sucks.
you said it was an old computer.
Yeah, I mean I've had it for like a decade, but it's just been like a solid trading computer. I only trade on it. But yeah, it just has some issues every now and then. So last time I took it in to add some RAM, I don't think I can do much to it. It's kind of you got to have the actual like processor be better. So it's time for an upgrade, I think, most likely.
Well,
so anyway, what are you looking at, dude?
So today, no one is here except for me and Hallie. But I think after this, we might head out just because the AC is not working here. So it's like 85 degrees in the office. So when we hit 11, I'm probably going to be done. But
Okay.
today, we started off the second half. PMI was softer, another contraction. Markets sold off, and then it came halfway back in this first 2 hours of trading. So I think no one really knows what is happening. I don't think anyone has a bias. All I can say is that this has been a pretty significant level in the past couple days on the 1 hour.
2 weeks.
And sorry, what'd you say?
I said it's been a level for the last 2 weeks. If we break that floor, that's what brings that CPI gap into play back to 537.
So what I'm kind of hoping for is if we do see a break in this, I see a retest here. If we see a break in that, we go to the daily. I see a retest down to here at 53. But there's so many levels of support that it's got to break that I think we're not going to really see a straight line, straight direction down. I think it's going to be like this. It's going to be this weird choppiness, and we're just going to see it grind lower. And it's going to be hard for traders to make money because picking a direction is going to be almost impossible right now. But, I'm not bullish, but I'm not super bearish. We were going into a Q3 and interest rates are still expected to cut. I think that's giving the consumer some confidence, but I think cutting now would be pretty awful for the dollar, especially since we see no clear trend lower. But I don't know. What do you think, Chris? What are your thoughts on the market going forward for the last 2 quarters?
Yeah, I mean, there's going to be so much drama in the next 6 months or 5 months of trading. I mean, right now you've got, we've been able to kind of ignore the political spectrum for a while, and now here it is front and center where, you have one debate. Everyone's like, oh my gosh, Trump looks better. Biden might not make it as a candidate anymore. So the Democrats are back to the drawing board. Who are they going to throw? Who are they going to vet out there? They're going to be future debates as we come into the election cycle. Is the Fed going to cut? I guess what I'm doing right now as far as actionable trading is I'm trading right now both directions on the SPY and the Qs through the end of this month. So I do want to see if we have some type of movement. I mean, I showed you that like look back stuff on Tasty and their platform. I talked to Tom Sosnoff. They're going to be rolling out another big update to have like futures feeds and all sorts of instruments where their back testing gets even more robust. But going out like 20 to 30 days, I mean, I like the idea of at least some type of gap fill. That CPI gap on the SPY is around 537. The NASDAQ would be the same type of thing. Just looking to see if the SPY and the Qs will pull back a little bit. They're the ones that are moving pretty much in tandem. So if the SPY is down because of, I mean, I guess what's weird is it going to be because of NVIDIA? Is it going to be because of the broad market sliding? Is it because, is Mag 7 going to get back a little bit of the gains? I don't know. I mean, you have to remember that there's forced buying in the markets every single month, So, I mean, if money's going into more Apple, more Amazon, more Google, more Microsoft, NVIDIA, I'm sure is getting lots of love too now that it's number 1, 2, or 3 in the world of the SPY. Look, April. If you look at how April behaved with the sell-off, April was a grind all the way through March. I was actually bearish timing in March. Let me fix my camera here. I was actually bearish going in through thinking, okay, January drift. February, some momentum. I'm looking to see a correction. All the technicals I was looking at, March, I was looking to get short. I should have just played both directions. And eventually we got the short and I made some nice profits in April, but I was wrong like on 2 trades going into like middle or late March. I could see this summer being the same type of thing as you expect to be wrong or you expect to be short, maybe seeing some bearish corrections in July. But if we have low volume and this week is, holiday on Thursday, FOMC minutes Wednesday, non-farm Friday, there's enough to move the market with kind of a low volume, like the market just takes a quick dive or a quick rip. But when kind of steady volume returns,
If we dip down, I could see it stabilizing and being bought right back up. If the market rips higher, I can see it fading. It's like, I do think that we might just enter a period where the market doesn't know what it wants to do, right? If the market doesn't have a clear path, and it's like, your chart's a perfect example. Are we breaking that trend line in the SPX? No. So as a bear, we don't have any confirmation. You're just looking at a floor over the last couple of weeks where if it breaks, yeah, we could go a little bit lower, right? But is it a bear market? Is it a, more than a single digit sell-off? Probably not. So from a technical side, I say it gets really choppy, which means what I'm trying to do is generate income. I think to do that, you go out 45 to 60 days. You don't try to pick a bunch of directions. You just go out what the market wants to do and stay in this positive drift environment, which is we just grind. We grind sideways, make money on out of the money puts. We grind up, you make money out of the money puts. We fall down. You can take some assignment, you can repair trades, you can take small losses, but you give yourself time and price cushion to be wrong essentially. But I'm just not super bearish, dude. I mean, I get that we could have a case for bearish, but look, if I'm bearish, I'm long VIX, which I am. I'm long bonds, which I am. I'm long gold, which I am, right? It's like I have trades that if we go bearish, there's other instruments that will perform for me. So for me to take, just a bearish outlook on the SPY or on the SPX or on the indexes in general, I'm just not. And part of me hopes, and not hopes obviously, but part of me wonders if the small cap trade is going to still be a good opportunity, going into this year. By the end of the year, is the Russell back up to all-time highs. I mean, one thing that would be really celebratory for the markets would be we continue to see all-time highs in the SPX or the SPY. We continue to see all-time highs in the Qs, but the catch-up trade would be the small caps.
Yeah,
right?
I think the most interest rate sensitive index will probably, I guess I can see it doing well if there's a rate cut.
Yes.
But I think it won't last. I don't think it's a lasting rally for this sort of thing. But I wanted to show you that. So yeah, we didn't break the trend line yet, but even when we did this trend line started in November of last year. Even when we did break the steady grind up, we thought this was the reversal time, but it wasn't. It started another trend line. So I don't know how it's impossible to figure out when you think the market's turning to this bearish overall sentiment where we're going to enter into like a 2022 or some long-term lower trend. It just doesn't happen. So even if this breaks the trend line and we come down to say this bottom, it could easily start another trend upward. So it's really hard to tell. I think your best bets are just going long, but when you're not long, or when you are long and you're caught in this sort of move, you're kind of screwed for a while. So it's just when you see a steady trend like this, wait for it to do something, make your move. I don't know. I have small short positions just in case things happen, but for the most part, I'm just kind of betting on these longer moves upwards. I'm not bullish, which sounds counterintuitive, but I'm buying, so I guess I am. I don't like buying here. Yeah. But I'm taking smaller risks than what I used to.
Sure.
I'm more weighted to the upside, but I have small short positions just in case. So I'm basically hedged. I think the market has run way past where it needs to be. And it's going to come back at some point. It's just when. And in the meantime, do we want to miss out on 3 months of this, or do we want to be a part of that until the correction happens?
Sure.
So,
well, I mentioned this earlier with Frank. With Nick. Type in JNK. Okay. I think this is something that, you and I should continue to pay attention to, because if we're going to see some type of aggressive sell-off, just compress that chart, go to a weekly, go to the daily, compress the chart, and look at the correlations with when we see the market selling off, look at what JNK does. So if you go back to April, and you can see that JNK was down a decent amount in April. Okay, go back to, I mean, our last real rip to the downside was 2020. I mean, since you go to 2022, you're going to see that JNK was going down. 2020, you're going to see that JNK was going down. 2008, of course, you're going to see that JNK is going down. So this is like the widening of credit spreads. This is the availability of liquidity. This is where risk starts to really poke its head out early. I would say if this is a slightly leading indicator to see where, you know, the market's getting a little bit, you know, long in the tooth, or the market's getting a little bit iffy on if it can sustain these levels. And so if you can look back and correlate these big drops in the markets relative to the JNK going down, I think that's one way to kind of simplify your trades. If you want to be bearish, this almost has to start breaking, you know?
So you're talking
What do you
about
see?
you're talking about lower prices on junk bonds?
Yes. So basically, when it's junk bonds, it's high yield, right? So high yield, it's like it's high yield, it's high risk. So if riskier assets are starting to be less attractive, that means that risk appetite is starting to dry up and it's starting to be more conservative and a flight to safety. So this is a good indicator to tell us if we're starting to see a flight to safety. So whether that's a rotation out of tech into other things, if that's a rotation into safety, if that's a rotation into bonds, if that's a rotation into gold, that's rotation into a lot of things. I don't know if, you know, the one question that's like, I would hope that value can outperform, because I think, you know, anybody, like, look, I've been trading for a long time. I know a lot of investors, you know, smart investors that had a great run in value from the early 2000s when the tech bubble burst, right? But I think the problem is we are such an entrenched tech market now in the US that I don't know if value will ever outperform the same way that it did during that time, unless we have a crisis. But I don't think that our tech right now, it's not overvalued unicorns. It's like NVIDIA fundamentally has a ridiculously strong balance sheet with you know, margins. I mean, you're paying for ridiculous multiples, but you're actually validating it fundamentally. The dot-com bubble was not that, right? The dot-com bubble was probably our closest thing we saw was in 2020, when you had SPACs and you had all these like shortcut IPOs that it was just like a blank check going to market and everything was up. Well, 2022 did away with all that. So I don't know if, you know, value is that much more attractive unless you want zero gains. You know, if you think about trading, I mean, look at a grocery store, look at a consumer staple sector. I mean, you're just getting, that's the grind. It's like your value is more of a grind. It's just not as volatile. I think that's the difference. Is now value is going to be more of a less volatile, not as big of the drawdowns, not as much of a reaction, and value might just stabilize. But if you want outperformance, it's like you just have to have tech in a good space. So anyway, my point is, this is what I'm watching. I think that if we start to break in a big way to the downside here, then I could see that the markets start to accelerate, you know, more to the downside as well. But as it stands right now, it's not. I mean, the VIX, of course, can spike up, and you know, look, my timing on the VIX might be dead wrong. I mean, I'm long through August with like a $12 VIX call. And I mean, I'm hoping we have a bit of a mid-July sell-off, because I'd like to see the VIX spike up to like $16 or $17. You've got 20 on your chart right there, which I would love. I mean, that would turn my call would probably be worth. I think I bought the call for like $1.25 or $1.50, and it'd be worth maybe $4 or $5 net. So I mean, I would take that as a decent hedge. But it's not moving off those floors. If we don't have a decent sized sell-off, like the VIX isn't going to go anywhere. So anyway, I mean, those are two things I'm watching. If I'm going to be more of a, hey, we should be really careful on this potential bear threat, this is what I'm watching. You got to see the VIX spike up, and you got to see the JNK break down.
Right. I've got, let's see, for VIX, I have July 24th call at $14. I paid
Okay.
$159. So I would like to see it above 16 by the end of the month, but if not, then I'll take that loss. But
Yeah.
that's what I mean when I say I have a small short position,
Mhm.
because the rest of it is just, looking for either spreads or just simple calls to the upside on the SPY. But today I've kind of been out of the market. I haven't taken any trades today. I'm just kind of looking around. But yeah, today didn't start off super hot. It's not showing anything of promise. Even though July is historically a bullish month, or like one of the most bullish months for the markets. It's just last month and the start of this month kind of show, you know, things are looking dull here. But I mean, that's just the start. We could end much higher. This could be a setup for another run to the upside.
Yep.
But we'll see.
Yeah, and I mean, and the reason that June, July tends to be bullish is it is definitely a lower volume market. I mean, I think if anybody is really waiting or anticipating a correction, it's going to be Jackson Hole in August. It's going to be September with a very typical September effect. There's typically tax loss harvesting going in. There's any bad positions are being cleaned up by usually September, and then everyone's looking forward to a Q4 that's arguably very, very bullish. But we've already debunked, like, the sell and may go away doesn't work. I mean, historically, October to April performs pretty much the exact same as May to September. Or I guess November, April to May, October. It's pretty much the same thing. So anyway, I mean, I like out of the money puts. I like out of the money. There's some like put condor is a pretty good trade if you want to define the risk. There's a combination where you can do like a put debit spread plus a naked put on underlines you're willing to own. You can collect income on that. I do that a lot on futures trades. So right now, I mean, probably one of my trades I'm looking at this week to get positioned for the next like 30 to 45 to 60 days. I'm just going to look at long silver, long gold, do those in the futures market. Maybe an index, but I'd like to see a pullback, Frank. I'd like to see a pullback towards the CPI gap. But I think gold futures and silver futures look pretty good for right now. I put a bunch of underlines in last week. So I think I did Google, Apple, Amazon, Tesla, NVIDIA. Those 5 were in last week for like that same thing, like that 30 to 60 day cycle. But gold and silver futures, I kind of like those right now as something that I don't expect there to be a lot of direction on either one. And so if I'm out of the money and I can collect a couple of dollars, per contract, I'll just do it.
So you're saying you're going to strangle gold prices?
Now I'm not going to strangle it. I'm going to stay bullish overall with just having puts as my underline. So,
okay.
So basically what I do is I could do just a straight up like wide credit spread and just keep it really simple. Go out of the money, do a wide credit spread, collect some income on that. Try to grab about 25 to 50% of the credit that I receive. And that way, if I went out 60 days, I can usually close the trade up within like 20 or 30 days. But the other one is you do a put debit spread in case you want to have any downside risk. And if I want to take ownership of the underlying, I do that on the SPY a lot. I do that on the Qs a lot. But I think just gold futures, I might just look at a larger credit spread. I might look at like a $2,000 to $3,000 buying power reduction, or look at like a $2,000 to $3,000 risk, like a 1.5% risk. But if I can take that and generate, maybe 3 to 5% off of that credit received, I'm okay doing that. So I just think directionally, like silver sideways. Silver's in a bit of a correction, but I think is postured well to the upside. Gold is totally sideways. And as long as we hold that, 2280, 2275 zone, I think silver is strong around that, 29 pullback. I think gold looks solid at a decent support level at 2270. You've got that trend line showing right there. It's like, yeah, if we get another nudge above, 20, I guess it'd be like 2400, 2350 to 2400. We get above there with some clarity and confirmation. I mean, gold gets back to the highs around 24 and change, 25 and change. But I've got a measure move on gold to 3,000. I don't know when, but it's like if I was looking out 12 to 24 months and gold's going to stay in this uptrend, 3,000 is pretty exciting. If silver goes to $35 to $44, that's pretty exciting. And again, what I like is right now, if I'm long on something, I want to have a measured move to get there. I want to have a justification technically to get there. The hardest thing right now is staring at an index like the SPY or the Qs and thinking we're going to all-time highs again and again and again. It's like, well, when does it stop? You know, I mean, because it's not like you don't want the markets to go up, but when they go up and they're overbought with divergence and it seems like it's a low volume drift, it's like all it takes is something to snap that back. And I mean, we can go up 15%. And here's a real example. Let's say we go up, 25 or 30% on the indexes this year. That could easily pull back 50%.
Yeah.
Right. So, I mean, you could be up 25 to 30% and the market can have some type of sell off, and we give back months and months and months of gains in a short amount of time. And that, of course, is like the scary part of being, fully invested and correlated is if the market's going to sell off 5 to 10%, you're going to go right along with it. So it's hard to be, all in the SPY because most of the time you're going to take on about a 3x risk for what you get. If you get 10% a year in the SPY, you're taking on a 30% risk at any given time, always. And that's
The higher we run, the worse it'll be.
I do not disagree. I think that's the scariest part is these booms and busts we have seen way more than, I mean, you can go back to 2018. We've had essentially booms and busts after we got out of the financial crisis in 2008, bottom 2009. It's been a pretty good uptrend for the most part, but we get into the last 4 years, especially 2018 end of the year with the rate hike cycle. We had a 20% haircut in 2018 in December. That was like a crazy crash. And then it was backstopped by the Fed in 2019. 2020, COVID crash. 2022, deleveraging, right? I mean, these have been literally boom and bust cycles. And they're backstopped by the Fed. It just seems like it's not a healthy rally. It's not a healthy market. But the way that it gets in these booms and busts, I don't think it's going to change. If the market's down, the Fed's going to do what they can to backstop it. They're going to do what they can to cut. I just think the difference is the Fed may not be going towards 0% interest rates, hopefully ever again. But if they do, it's the same song and dance we've seen for the last, decade plus. So anyway, I mean, it's not easy. I think the positive drift is for real. I think the market, if it goes sideways, it's going to drive traders crazy, Frank. I mean, if it goes sideways and it's like, man, we can't get any direction. It's very true. I'd rather do this. I'd rather trade and make money with no direction. I'd rather trade and make money with a little bit of downside, because I think that's the reality is we have little downside. But if we go a little down, nowhere, up a little, up a lot, I want to make money those ways. That's 4 out of 5 ways to make money. The way I don't make money is a big fat collapse, which I'm hedged for, which I can also manage some of that drawdown and alleviate some of the pain. So, I mean, from that sense, if it's really bad, I'm okay and I'm protected. If it's down a little, sideways, up a little, up a lot, we make money. I'd rather do that than try to be, crazy bullish and crazy directional or crazy bearish and crazy directional because, I just don't think it's profitable to position for a black swan event when you never get it. There's a reason a black swan event is every, 10 years, every 20 years. It's not every 2 months. It's like right now it seems like the market, like it's got to go down. It's got to crash. It's like, why? It never does. We just had a crash in 2022. That was a 30% correction. The market is now recovering from that. And fortunately it's at all-time highs. So I just think we have to use history as our guide,
At the same time, though, there's still those red flags. We have, what is it, the 3-month and the 10-year yield still inverted for how many years now?
October is going to be 2 years. We had talked about that. Like that 2-year mark is historically the average when we start to see a recession. So, could the market kick it back a little bit? Sure. If the market is going to kick it back where, hey, this is 24 months, we stretch a little bit longer, we get through a Q4, we get through the election, the Fed is accommodated by cutting rates a little bit, and the market likes it, I could see that inversion lasting through maybe this year and then flipping hard into 2025 where it all changes. So, I mean, like I'm way more skeptical going into this type of gain and bullishness into 2025 than I am right now. Like right now I can see there's a reason for, steadiness. If we have a dip, I could see the market dipping and then the market gets really excited through the election for whatever reason to kind of save itself. But I don't know. I mean, I hope the market just remains pretty steady because that makes trading relatively easy. You know, I mean, I look, I know that if the market's up, down, or sideways, I'll find a way to make money. But for the general investor out there, passive or active, it's a lot easier to trade bull markets, man. You know, I mean, for the average person that's participating, look, I'm a fan of anybody that's interested in trading. If you want to learn how to trade, do it. You should. It's one of the greatest things ever. I love what I do. But for the trader that is learning, or the trader that's not prepared for a crash and the pain that it takes to experience a 2022 or a 2020 or 2008, it's not fun. It's easy to look back in hindsight and say, like, well, I just bought it there at the bottom and I made a ton of money over the next 5 years. But the pain it takes to see your portfolio go from all-time highs and lose 30%, 40%, 50%, if you're heavily invested in tech, lose 60, 70, 80%, that pain makes people quit trading. So it's a lot easier to trade a bull market. It's a lot easier to see the market drift and go higher, you know? So
well, that's why that's part of the reason why it would be nice to have that black swan event, is because you get a terrible correction that is long overdue. And I know we just had one in 2022, but we ran way further than that too. Like, these recoveries are much harsher. These crashes are much worse.
Yeah.
They happen quicker. But
Yeah, for sure.
I'm just thinking that if we can just see, if we saw a really bad one, that means probably for the next decade or so, at some point, you will have that those steady gains to the upside, and you can build your portfolio. You don't have to worry about these weird directions and the choppiness day in and day out. You can just keep buying, and that's kind of what I want. While I'm young, I don't want to be going into my 30s in an extremely overbought market. So I would like to see some discounts at some point.
I don't disagree, but again, it's not just about you, Frank. You've got 70, 80-year-olds that have their portfolios at all-time highs that don't need to be invested in equities the way that they are. I mean, think about if you're invested in with a financial advisor and you're a bunch of mutual funds that are 95% invested and 95% correlated with the market. You know, I mean, I want to see a crash too, because I'm usually only about 40 to 50% invested, and I have a bunch of cash on the sidelines ready to deploy. So I'm doing the same thing, you know. But the reality is, if we have a crash, you're watching portfolios get cleansed, and if you don't have the cash to buy again, you're just hoping that it comes back. So you and I are, I mean, as traders and investors, if you have money on the sidelines ready to deploy, you want the crash, you want the correction, because then you can deploy your cash because it's a good opportunity. But when you're fully invested, and I'm speaking broadly for like the passive investor community, when you're fully invested by mandate, fully invested because you're just in a bunch of mutual funds and you don't have protection to the downside, you go from all-time highs to whatever the market's going to make you, bow to. If the market has a 20% cleanse, your $1 million portfolio just turned to 800 grand and you didn't do anything other than watch it go down. And now you're hoping that it gets back to $1 million plus 3, 4, 5 years later. That's a terrible feeling. So, there's a difference between trading, and managing a portfolio, and there's a difference between just investing and staying invested and just watch the market drift all-time highs. I'm right there with you. I want to see corrections. I saw
you're right. We can continue this later on, or
That's fine.
or over chat or something. But I got a text from James. We have to get Nick Phillips on now because it's past 11. It's 11:03 right now. So
all good. Well, I sorry for my little Google Chrome deal. I'll get that fixed for tomorrow. But good talk.
No worries.
See you tomorrow. All right. Thanks, James. Yep. Thanks, Frank.
Thank you.
See ya.
What is going on, everybody? Just saw Chris and Frank having an awesome conversation. Sorry to kind of boot them off, but excited to be here, guys. I'm gonna go ahead and share this with my audience as well, real quick. and then we will get going. Okay. All right, guys. New week, new quarter. Let's take a look at a couple things here. Let's see how the Doxy is shaping up. Go over here to this chart. All right, so PMIs this morning came out mostly contractionary, but we had a little bit, even though ISM new orders came out contractionary, being below 50, we did get a higher than previous and higher than forecasted number for them. So sort of a mixed bag here this morning. Prices paid, again, above that 50 number, but slight contractionary information from previous and the forecasted expectation. And then ISM headline manufacturing came out below 50, so contractionary in that regard and contractionary as far as previous and forecast is concerned. So mostly contractionary scenario situation happening this morning out of the ISM numbers. But this one right here kind of created a mixed bag, and it seems the market really, it gave this initial spike to the downside here. But I guess we started to price in that this slightly higher than expected new orders, and Doxy just went, continued to push to the upside, giving back some of these losses from Friday of last week, Thursday and Friday. Looks like the dollar is gradually reversing now, giving back all its gains in the last hour. Let's check it out on a. Yeah, it's interesting seeing this kind of push up here the last few weeks of June. Gonna be a really interesting story as we start to get some more data this month. Hopefully, for those of us that are wanting some dollar downside, hopefully we start to see some more solid contractionary information out of the economic data hitting the board. Really interested to see how this quarter goes. Election cycle right around the corner. That should be exciting to trade through. Let's check out the NQ now. Doxy is just absolutely rallying to the upside this morning. NQ, I believe, we're down on the day. Down in the morning, not too heavy. A little bit of consolidation here actually since about the open. Open here, we're down, but consolidating in this 19.9 area, 19.9, 19.950. So this seems like a bit of a quiet Monday as far as where's price going. We really just have NQ stuck in this range here since about the New York Stock Exchange open. Having a hard time pushing farther on this new leg here after about 10:30. So the last 30 minutes haven't been able to continue to push down. Trying here, but rejecting it out of this 870 area. Let's go check out SPX real quick. Similar story, although a bit weaker. At some of these, it's at last week's low. Dipping below this point, I think, next batch of support areas will be in between the 54.75 and 55 area, 5,500 area. I think if price dips down into here, we're going to see at least on a short term, little bit of some price action like this, where then, our next contestant area will be in between, 550. Looking at the economic calendar, let's go to Forex Factory real quick. I believe CPI is next week. Yeah, CPI being next Thursday. NFP obviously this Friday could give the markets a significant push, but I would almost expect us to hang out in this area until CPI next week. Could be wrong. If NFP gives us significant cooling, that will change the game. But a continued strong NFP, I don't really think is going to factor into the market too much. The Feds have been saying for a while that strength since, I want to say, April or May, they've been saying strong labor data isn't necessarily going to, factor in too much into their monetary policy decisions. So another strong NFP print, we may get some temporary volatility out of the dollar pushing up, but I don't know if that's going to be enough to continue to push it and maybe break some of these 106, 106.5 levels. But weaker NFP, significant cooling in the NFP could see us really fall to the downside. I would definitely expect, a significant cooling in the labor market to give us that doxy weakness, some initial doxy weakness. And if we get cooling, follow that up with some cooling with CPI, and we may be in the running for that those pullbacks here on the doxy, which is honestly what I'm looking forward to. Hoping we start to get that personal bias, wanting some of those interest rates to start coming down, so I can more comfortably start to look at buying a house, because these current levels are not enticing. So let's see. If you guys trading metals with different trading currencies due to high volatility of the market, I think you're right. If you guys have anything you want me to check out, feel free to drop them through the chat. It's a Monday. I'm usually not too interested in trading on Mondays, depending on the data set hitting the market. Tried to take a stab at the PMI numbers this morning, even though it was mixed. I maybe should have stayed on the sidelines and avoided a unnecessary little 0.5% loss there on my account. But it is what it is. We took a stab on odd USD, really the odd futures. Tried to take a stab at the buys here, lower time frames. We got this initial spike up and started to try to grab some buys down right here on this leg as we started this push back up, and just ended up getting tagged out here below the structure point. So good thing though, proper risk management, got out, had a good idea of where we wanted to get out, and we got out via our rules. The market continued to tank to the downside for the odd. Let's see, what are we looking forward to this week? I mean, the big thing is NFP. I don't know if I'm going to be paying attention to this Fed chair or this Powell speech tomorrow. JOLTS job openings will be a good one to factor into the overall labor market, as far as, are we going to get, softening? The market is expecting a softening number, a little bit less demand for labor out of the openings here. That's what we're expecting. So if we can get significant cooling here and then significant cooling on the NFP numbers this week, I think we will be well poised for a contractionary scenario here out of the economy. Let's see, my projections on gold is a massive bullish push to the upside. Then my projections for NFP is a massive drop in favor of the dollar across all dollar pairs. So you're saying you're expecting a drop in the NFP numbers. I don't want to butcher your name, Chidu. Gold is always interesting for me as far as a tradable opportunity out of metals in general, but specifically gold. I tend to really only trade gold in risk sentiment, like heavy risk off scenarios where investors are dumping their money into gold because a new war pops off, for instance. Those are the best times for me. The most how can I say it? I like to identify that what I deem to be the highest probability opportunities in the market. And so with gold, the highest probability opportunities for me always are, if we get a new war that pops off right here, where price is trading in these areas, and all of a sudden, let's just come up with two random things. Mexico attacks Venezuela, and it's a brand new war that hits the market. Well, then all of a sudden, the odds are gold should start to rally from that point. So for me, that's how I like to trade gold is really as like a safe haven in times of war. Gold on 2-minute performance. How was gold correlating with the dollar this morning? Gold is sort of as far as the 2-minute performance goes, we're just in a bit of a pullback here from these down legs. Let's just mark off a couple technical areas here. We got a high, then a low, then a lower high, and a lower low, and now theoretically making a lower high here at this previous resistance level. On the 2-minute, of course, looking at scalping opportunities, potentially selling out of this 2339, 2340 area, somewhere on this leg back up. Yeah, I tend to only look at gold during wars. I tend to not trade gold unless a war pops off or something else happens in a war scenario that is pretty big. I should have had this prepared for. I'll try to prepare this for next time. There was a specific date a couple Sundays ago where the market opened. It was I think it may have been a Wednesday. Anyways, it was Asia market open, and the chief of staff of Hamas got killed in a bombing. And so not every bomb once the market reacts to a war, like let's say Israel and Hamas popped off, I think on October 7th, October 9th. The market reacted for a solid few weeks. Well, then after that, we still get little headlines about there was a bombing, it killed so-and-so many people, Israel's going to react, or Israel bombed Hamas and so many people died, and Hamas is preparing to retaliate or something. Like at some point, the market stops reacting to those headlines once it's already kind of factored in the war itself. And then it's going to take something sort of major, a new major headline, in my experience, a new major headline to get that risk off sentiment to factor back into the equation when it comes to gold. So when the chief of staff of Hamas got killed that Wednesday afternoon, literally right as Asia session started, I got the notification about 20 minutes too late, but I went and looked at the chart. You could see gold was starting to, it was on a bit of a downtrend, and then that headline hit the markets, and within 2 minutes, gold started rallying to the upside. So, safe haven flows in that regard, for me, seem to be the explanation. Again, it's not every headline after the market adapts to the idea that a new war has happened. But you can see here, let's see, what time is it? 11:20. Let's back out to, I've gone over this before on the stream, but I'll touch back on it again. It was a Saturday, October 7th, I believe. So yeah, it was Saturday, October 7th. The Israel and Hamas war, like really, it kicked off this last time. I know there's a long history there, and I'm not an expert in it, but I know that October 7th was like the big, most recent Israel and Hamas, or Israel is at war again. And we immediately see the market price in war tensions. And then it started to fizzle out here. So I believe, what is this, 2 weeks later? Within about 2 weeks, the market had sort of priced it in. And then I wish I could remember the exact date that the chief of staff died. And for whatever reason, last time I was Googling it, I couldn't find anything on it. But it was, I want to say it was in May, or it was either May or June. And it was like a random Wednesday night around Asia session. Do you hold actual gold coins? No, I don't. I've considered like buying some, but I don't. Most of my investments have always been tied up in real estate, like outside of the market. It's, I don't really hold anything physical other than real estate. But I have considered getting gold coins. I think even if it's just out of like this would be cool to hold. That's kind of my idea behind having gold. Now, if I was to start seriously investing in gold, it would, that's a completely different story. And I would have wanted to do that maybe at a different time. Like, it would have been obviously Hindsight Capital, Hindsight Capital Group. It would have been amazing to start buying up gold 10 years ago, but I was 18 at the time, not thinking about this stuff. So, but yeah, I don't know if I would buy physical gold right now. I mean, you could. If I was to do it right now, it would just be for the cool factor of having some gold. Where are we going with the euro dollar? Let me check that out. Euro is interesting right now. I actually have not checked on the status of the elections. It's a recent low here. Weekly is kind of stuck in a range. I think a lot of where we're going to go with the euro dollar is, it's going to depend on a few factors. Monetary policy obviously being one of the biggest ones. I think what's going to happen here with the euro dollar, potentially, if we don't get my ideal scenario in the US, which my ideal scenario in the US is weakness out of the dollar. We start to look at cutting rates, like a serious, significant weakness out of inflation, significant weakness out of the labor market, so that the Feds can start to seriously consider giving the market the rate cuts that at least consumers desperately want. If we don't get that, if we get continued stickiness out of inflation and maybe some continued strength out of the labor market, then I think euro dollar is going south. I think we're going to start to see it break these lows and possibly come back down to these 104.5 areas. If, of course, euro continues to cut rates, which they've been a little back and forth lately, if I remember correctly. Dollar strength looking stronger, only maybe. Euro USD is now reversing in favor of the euro. Euro just hit support on yesterday's highs, currently reversing. Yeah, so Euro USD is interesting right now because of the France elections. I would have to read through these to get a little bit more of a solid understanding. 12 million of our fellow citizens have voted for a far-right party that is clearly... Okay, so this is very political right now. Let's see if we can get any... So I'm gonna have to look into this a little bit more. The reason why I wouldn't buy the euro going up, honestly, is because of the political turmoil right now in Europe. I definitely, you wouldn't see me buying this right now. Maybe on some scalping scenarios purely based off of technicals. We start to hit some support areas for sure. Which obviously we're coming down into this previous resistance zone here, which could prove to be a decent area for potential scalps. If you're just thinking about it on a technical standpoint and not really taking any fundamentals into account. Yeah, I think in this area you get the right kind of price action out of the market here. The market shows you, that it's trying to push maybe below this and can't. Tries to push a couple times, tries to push, and cannot break below this 107.15 area. Then yeah, buying up, scalping it out of here. It all depends on your style. That's how I would trade this. I would try to scalp it out of this area once I get proper price action. And we're coming towards London close. I'm not sure that I would do it today. If you were going to be looking to scalp this out of here, I would see if we hang out in this area until London tomorrow. And then if we're still in this area, even if we pop up and pop down and pop up and pop down and pop up and pop down, if we're hanging out in this area tomorrow ahead of London open and you start to see some volume to the upside, I think this is a prime area to start, taking some scalps to the upside. But as far as long-term swings either way, I'm not touching the euro dollar right now, mainly because of the political tensions going on in their country. Can I see big unrest in Europe this summer? You kind of already see it. I guess big unrest is sort of, what is the word? It's relative, right? So we saw the euro significantly fall off once snap elections were announced. And so that sort of political turmoil creates some unrest in the area. Anytime you have any kind of surprise political situations, it's going to cause some unease. It's going to cause some fear, uncertainty, and doubt in the area for sure. All right, guys. I think that's about all I have for today. Again, it's a Monday. I'm really not looking to get involved in anything else for the day. I'm gonna let the market hang out and do its thing. We've got July 4th in the U.S. on Thursday, so interesting week. We have quite a few pieces of economic data, but we also have a major holiday. I started hearing noise. I was like, "What is going on? What's up, Nick?"
Sorry about that. What's going on, man? How you doing?
I'm good, man. How are you?
I'm good. Yeah, busy, like you were saying just a second ago. Busy week this week, and should be a good one. Are you? I think you're coming back a couple times this week, right?
Yeah, I haven't checked the rest of the schedule yet. The last time I checked the schedule, today was the only day that I had. But yeah, I think I let you guys know I have plenty of availability this week. The only time I'm not going to be available is on the 4th and then tomorrow. So
sure. Okay. Awesome. Well, Nick, thank you for coming on the show and hanging out for a little bit. For anybody who's listening, if you enjoyed that segment, you can find more from Nick on his own YouTube channel. We just dropped a link to his right here, official Nick Phillips there. Check him out for sure. And Nick, thank you very much for coming on and sharing some thoughts.
Yeah, no problem. All right, guys.
All right, man. See ya.
See ya.
All right, guys, we're going to go for just a few more minutes here. Just wanted to kind of follow up with where things are at here for the day. Gold is completely flat on the day. The dollar index is higher on the day. Really impressive kind of turnaround for the dollar index. We did hit that 105.5 level and just boom, shot right off of that area. We'll see how that progresses, if it can kind of continue pushing one way or the other. It may be
that the dollar index is headed up to test that 106 kind of range, 106.4 that we keep talking about. We'll see what happens there. If it does get up there, my opinion would be it's probably extended unless something changes with the NFP report this week. If you get a really hot jobs data point, the dollar could continue higher. So we'll see. I am sort of neutral on the dollar. I've stayed neutral. If anything, I lean slightly bearish just because I am bullish on gold, bullish on silver. WTI really making a move here this morning as well. Could be increasing inflation concerns. Yields are up on the day. Longer duration getting even more of a boost today. So kind of interesting to say the least. Bitcoin, I do have a long position on Bitcoin. It was up this weekend, giving back a little bit of gains here today, but I am still long Bitcoin. Ethereum, I don't really have any positions on. The euro rejecting this level seems at the 1075 level. Pound USD also rejecting, selling off, and dollar yen continues its climb, its endless climb, it seems, higher. There's dollar Swiss completely taking out resistance. I thought we would get a more reaction here. I didn't take the trade, but obviously I'm glad that I didn't, because it would have probably been a loser for me, but I didn't touch that trade. The Australian dollar also rejecting again off of these highs. I would like to be long the Aussie dollar if we get a breakout through the highs. I've talked about that recently. So we'll keep an eye on AUD USD. If I take that trade, I'll share it inside of our Discord room. And I just also wanted to mention, guys, if you haven't already messaged us about the sale, we are currently doing our half off sale here for the EDGEFINDER. We're doing a summer sale this week. It is a short-term sale here. So if you are interested in getting a copy of the EDGEFINDER at a massive, massive discount, the price is half of what it usually is right now. And it will be going back up shortly. This is the biggest discount of the entire year. I mentioned this earlier. If you're like waiting for a good deal, it won't get better than this. This is the lowest that it goes. So if you've thought about getting a copy, we're going to drop a link here in the chat to where you can get some information for that. If you click the link here, it will take you to this chat location where you can speak directly to a representative on my staff who will get you set up with a copy, get you some information. So just hit that, click the 55% off summer sale. For people who are watching with us live right now, you can get 55% off the EDGEFINDER. And by the way, you can bundle the membership with it. If you're thinking about getting that, you can also get that for a super discounted rate. So come trade with us, get access to our tools, whatever you'd like to do, and take advantage. That's going to wrap it up for the show here today, guys. Thank you for hanging out with us. And thanks to all of our guests and audience for being a part of what is the A1 Trading Show. Thanks so much, and we'll see you back tomorrow. See you guys.
Our summer software sale is happening right now, which means you can get the EDGEFINDER for 50% off. COT data, top setups, pages of fundamental and technical data, and so much more. Our software is constantly scanning for new data and information and is updated regularly. The EDGEFINDER is a one-time purchase, which means you can get it half off right now and never have to pay for any updates made to the EDGEFINDER software. This limited time offer won't be around for very long, so don't wait and get this incredible trading software for half off before it's too late. Check out the link being dropped in the chat now to talk to one of our team members about our huge 50% off summer software sale. Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.